Five S&P 500 companies are offering dividend yields above 5% in 2026, drawing attention from income-focused investors seeking reliable returns. Among them, Healthpeak Properties leads with a yield of approximately 6.3%, following a notable 20% year-to-date gain. This performance reflects a broader trend as investors gravitate toward stable, cash-generating assets amid market uncertainty and elevated Treasury yields. Verizon Communications is another standout, with a yield near 6.1%. After shedding 13,000 employees in 2025, the telecom giant has seen its first positive subscriber growth in a decade, signaling a potential turnaround in operations. This shift suggests that the company's restructuring is beginning to yield results, particularly in a competitive wireless market. The mechanism behind this recovery is clear. By streamlining operations and reducing overhead, Verizon has been able to focus on customer acquisition and service improvements. This is critical in an industry where customer retention and network performance are key differentiators. The stakes are high, as any misstep in maintaining this momentum could lead to a reversal in investor confidence. Realty Income, known for its monthly dividend distributions, continues to attract income seekers despite facing headwinds from high interest rates. The company's consistent payout model remains appealing, though rising borrowing costs may pressure its margins. The next signal investors should watch. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Is how Realty Income manages its real estate portfolio in a high-rate environment. If the company can maintain occupancy levels and secure favorable financing terms, it could continue delivering stable returns. Meanwhile, Altria has managed to grow revenue despite declining cigarette sales, thanks to strategic pricing adjustments. This demonstrates the company's ability to adapt its business model in a challenging regulatory and consumer environment. The key mechanism here is pricing power. By increasing the cost of its products, Altria has offset declining volume. However, this strategy is not without limits, as consumer pushback or regulatory intervention could disrupt these gains. The fifth company in this group is also performing well, though specific details are not fully disclosed in the evidence. Collectively, these stocks are capturing investor interest because they offer a combination of strong yields and resilient cash flows. In a market where growth equities remain sensitive to interest rate fluctuations, dividend stocks with predictable distributions are becoming increasingly valuable. However, investors should remain cautious about the sustainability of these yields. For example, Verizon's recent subscriber gains may not persist if competition intensifies or if macroeconomic conditions deteriorate. Similarly, Realty Income's monthly dividends could face pressure if borrowing costs remain elevated for an extended period. Altria's revenue growth is also dependent on its ability to maintain pricing power in a sector that faces ongoing regulatory scrutiny and shifting consumer preferences. The broader context is one of heightened uncertainty. With Treasury yields remaining elevated, investors are seeking assets that provide consistent income without exposing them to the volatility of growth stocks. Dividend stocks, particularly those with a history of stable payouts and strong balance sheets, are well positioned to meet this demand. However, the current yield levels may not be sustainable if companies face increased pressure from rising interest rates or declining sales. Investors should monitor key signals such as quarterly earnings reports, changes in dividend policies, and most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Shifts in the macroeconomic landscape. These factors will determine whether the current high yields can be maintained or if adjustments may be necessary. For now, the 5 companies highlighted in Barron's report offer a compelling mix of yield and performance. They represent a diverse set of industries, including telecommunications, real estate, and consumer goods, which could help mitigate sector-specific risks. As the year progresses, investors will want to track how these companies respond to evolving economic conditions and whether their dividend policies remain intact. In the meantime, the current environment continues to favor dividend stocks that demonstrate strong cash generation and a commitment to shareholder returns.